Well, the markets just witnessed an absolute bloodbath. Gold and silver, the assets investors typically run to for safety, they just went through a sudden and pretty brutal sell-off. So we're going to break down what exactly triggered this historic crash, why it all happened so fast, and what the experts are watching for right now. Just to give you a sense of the scale here, look at this number. In a single day, the price of silver just plummeted by 34%. I mean, this wasn't just a bad day. It was the largest single-day percentage drop the metal has seen in decades. Just staggering. And that brings us to the central question, right? Why did the very assets that are meant to be a store of value suddenly fall off a cliff? We're about to unpack the perfect storm of factors that led us to this exact moment. Yeah, this wasn't some slow, grinding decline. This was a violent reversal that caught almost everyone completely by surprise. Let's dig into the numbers. Now, what's really wild here is the context. This didn't happen in a vacuum. It came right after a rocket ship ride to record highs, and then the market just completely fell apart. Gold dropped over 10% in a single day, breaking that huge psychological level of $5,000 an ounce, and silver, like we saw, had its worst day since the 1980s. The market basically went from extreme euphoria to extreme fear, seemingly overnight. So what on earth could trigger such a dramatic reversal? Well, it turns out it wasn't just one thing. It was a combination of three really powerful catalysts, all hitting the market at the exact same time. Okay, first, a major political move, the nomination of Kevin Warsh as the new Fed chairman. That signaled a potential shift towards tighter money and a stronger US dollar. Second, you have simple human nature, profit-taking. After such a massive run-up, a ton of investors just decided, you know what, it's time to cash out. And third, the exchange itself stepped in. The CME Group raised margin requirements, which made it more expensive to hold a position, basically forcing some traders to sell. And this slide right here, this explains the core dynamic. Precious metals are priced in US dollars, so when the dollar gets stronger, it takes fewer of those dollars to buy an ounce of gold or silver, and that pushes their prices down. So nominating a more hawkish Fed chair, that is someone more likely to raise interest rates, was a direct signal for a stronger dollar. The metals market reacted instantly. All right, so now that we know the why, let's move on to the what's next. And to understand that, we need to look at the charts and see the key price levels that professional traders are now watching like a hawk. But before we look at the specific numbers, we need to understand this term, a support level. Just think of it as a historical price floor. It's a zone where, in the past, buyers have consistently jumped in to stop the price from falling any further. In a big sell-off like this, these levels become absolutely critical. And here's what that looks like for gold and silver right now. For gold, the big support zone to watch is between 4,360 and 4,900. If the price can hold there, that's a good sign. But if it breaks below that, well, the selling could accelerate. For silver, that key floor is that wide zone between $70 and $80. Holding that crucial floor is absolutely vital for the bulls. Now, beyond just price levels, traders use these tools called technical indicators to measure a market's momentum. One of the most common is the RSI, or Relative Strength Index. It basically tells you if a market is overbought or oversold. Think of it like a car's tachometer. If the needle is stuck in the red zone for too long, you know something's probably about to give. And this is fascinating. Just before this massive crash, both gold and silver had RSI readings way above 80, deep into that red zone. This was a classic warning sign that the rally was extremely overbought and getting exhausted. Now, these indicators don't predict the future, of course, but they were certainly flashing red that the market was vulnerable to a sharp reversal. So all of this brings us to the big debate that's now raging among analysts. Was this just a healthy, though really violent correction? Or is this the beginning of a much larger, more prolonged crash? And there are two very clear sides to this argument. The bulls, they say this was just a necessary reset after a bubble-like run-up. They argue that the long-term reasons to own precious metals, things like inflation fears, are still totally intact. The bears, though, they're warning that if those key support levels we just looked at are broken, it could trigger a much wider wave of selling. They also point out that silver, with its huge industrial use, is very sensitive to a potential economic slowdown. And to put a really fine point on just how serious the bearish case is, some analysts are now forecasting that silver's decline might not even be over, with the potential for it to fall by another 50% from where it is now. Okay, so amidst all this chaos, what are the key principles to keep in mind as you're watching these markets? Let's try to distill it down to the essentials. First, and this is probably the most important thing, try not to panic. Volatility like this is a feature of markets, not a bug. It happens. Second, keep your eyes on those key technical levels we talked about. How the price acts around those zones will tell you a whole lot about where the market might be heading next. And finally, be really clear on your own strategy. A short-term trader is going to react to this very, very differently than a long-term investor would. Which leaves us with the ultimate question, doesn't it? Was this historic plunge the end of the great precious metals bull run, or was it simply a violent but maybe necessary reset before the next leg higher? The answer is probably going to depend on monetary policy, market sentiment, and whether those crucial lines on the chart can hold. Thanks for tuning in.